Past 37, provisions, contingent liabilities, and contingent assets. So in this particular standard, we are to talk about two items. So this is a mixed standard. So when we say mixed standard, it does not pertain only to an asset section or a liability section or an equity section, but it talks about both liability and assets. So as you can see, we can recognize or disclose contingent liability and contingent asset. What is important in this particular standard, you need to draw the line on when can we say it is a provision and when can we say it is a contingent liability. So what is unique in your provision so that we can say it is a provision, and what is not in your provision so that we can say it is a contingent liability. And then finally, we are to measure a contingent asset. So let's start by first, of course, defining what is a provision. So a provision is an existing liability of uncertain timing or uncertain amount. So here, take a look that in your provision, it is considered a liability. So when we say it is considered a liability, there is already a past event known as your obligating event, which now creates your liability. So remember, one unique characteristic of a liability, it is just based on your past event, and there will be an outflow of your economic benefits. So based on your past event, which creates now an obligating event, your main problem in a provision is the uncertainty. So what is this uncertainty? So uncertainty as to either timing or uncertainty as to the amount. So you're uncertain on when will you pay that liability, that is your timing. Uncertain as to the amount you will pay on that liability. Okay? So although you have already an obligating event, meaning there is already a liability, so there's a past event which creates now the obligating event. And based on your obligating event, you're only uncertain as to when will you pay it, the timing, or you're uncertain as to what amount will you pay. Okay? So there is uncertainty as to when and what amount. Okay. Now, take note when we talk about your obligating event can either be a legal obligation, arises from contracts, law, or statutes. And we have also your constructive obligation. This constructive obligation is based on your different assumptions or a based on your different actuations that now creates an obligation as to your different users. Okay, so normally in your what do you call this one? In your constructive obligation, it creates now a expectation. It creates now an expectation as to your users, which because of that expectation, it creates now a liability. For example, wala naman sa kontrata ninyo na magbibigay ka ng bonus. So there's nothing in your contract that you need to pay bonus to your employees. However, for the past years, you always give bonus to your employees. So there is already an expectation that your employees will receive a bonus. So based on that valid expectation, it creates a liability on your part to really pay a bonus. That is considered a constructive obligation. When can we consider that as a legal obligation? If ever in the contract itself it says there that there should be a bonus annually, then that is a legal obligation. But if it only creates an expectation, we call it your constructive obligation. So those are your obligating events. And your problem on your obligating events, the timing, when to pay it, and the amount, what to pay. Okay. So when do you use a provision? Your provision must be used for every separate obligating event. So we already know what is an obligating event and when can we say it is a provision. However, when do we recognize a provision? So recognition of a provision. First, it must be a present obligation. We already said that for it to become a present obligation, it must be based on a past event. And your past event must create an obligating event. Next, we recognize it if it is probable. Take note, there is an uncertainty of timing. So when we see uncertainty of timing, when will it be paid? So when we talk about probability here, we talk about the occurrence, meaning the occurrence of payment is more than the non-occurrence. Okay. Probability, again, we have a probability problem as to your timing. So as to this timing, our main recognition criteria is the probability whether it will occur or not occur. But the rule of thumb here, the occurrence must be more than the non-occurrence of that particular liability. Lastly, it is measurable. So one problem in your provision is its uncertainty as to amount. So although it is uncertain as to amount, it is still capable of being estimated. Take note, it must be probable, okay? And it must be measurable. Once it is probable and measurable, we have a provision. I told you, we need to draw the line between a provision and a contingency. Once it is probable and measurable, we have a provision. Sir, what if it is only probable but not measurable? It becomes now contingency. If it is not probable but measurable, it becomes now a contingency. So that's the difference between a provision and contingency as early as now. A provision, when do we recognize it? Once it is probable and measurable. If the two items are present, we have a provision. But what if it is probable but not measurable? Contingency. Not probable but measurable? Contingency. Okay? So again, provision, probable, and measurable. Uncertain as to timing and amount. We go now to your measurement. So a while back, we said that there is uncertainty as to amount. Okay. However, we also said that it is capable of being estimated. So how do we measure it? So the following are the measurement techniques to measure our provision. Take note, once you recognize, so we're done with recognition. When can we recognize it? Probable and measurable. You are now to measure it. So how do we measure it? We measure it based on your best estimate because again, we must be it must be capable of being estimated. So whatever is the best estimate based on your estimation, that is the amount. So if the problem tells you that the best estimate of the liability is 3 million pesos, so the value then is 3 million pesos because that is your best estimate. Next, if there is a continuous range. What is a continuous range? There is a continuous range, guys, if ever we have a lower limit and an upper limit amount. So for example, the liability, it is estimated that the liability will be from 3 million to 8 million pesos. 3 million to 8 million pesos. So there is a lower limit and an upper limit. If that is a continuous range, you will measure it based on the midpoint of the range. So if we have 3 million plus 8 million, we divide it by 2. The midpoint is 5.5 million. That is the value of our liability. Okay, so here under your continuous range, it happens if you're given lower limit and upper limit. Next, you are given large population of items. When we say large population of items, then we need to take a look into your different possible outcomes. So population of items talks about your outcomes. So for example, outcome 1 is 3 million pesos. Outcome 2 is 5 million pesos. Outcome 3 is 7 million pesos. Outcome 4 is 4 million pesos. So those are the different outcomes. So these outcomes are considered large population of items. So if you are given large population of items, how will you measure it? By weighting or a statistical method. So how does your weighting or statistical method works? Your weighting or statistical method works by first getting the weight of a particular outcome. So let's say outcome 1 is 20%, outcome 2 is 30%, outcome 3 is 35%, and outcome 4 is 15%. So 20, 30, 35, and 15. If that is considered weighting or statistical method based on your outcome and based on the weights, we just multiply the values of the outcome and the weight. That is the value of our provision. So we have here 3 million times 20%. So 600,000. 5 million times 30%. We have 1,500,000. Next, 7 million times 35%. So 7 million times 35%, we have 2,450,000. And then lastly, 4 million times 15%, we have 600,000. So total, 600 plus 600 plus 1,500 plus 2,450,000, we have 5,150,000. Okay? So again, once you establish that you can recognize the provision, meaning it is probable and measurable, then your next problem is measurement. So how will you measure it? You measure it based on best estimate. The best estimate is given. So if the problem tells you that the best estimate is 3 million pesos, that is the best estimate. If there's no best estimate, there can be a continuous range. When is there a continuous range again? If there is a lower limit and upper limit, how to measure it? You get the midpoint of the range. So for example, 3 million to 8 million, 3 million plus 8 million divided by 2 to get for the midpoint, 5.5 million. Now, if there is no best estimate, no continuous range, there can be large population of items. So if there's large population of items, you get for the outcomes. So based on the outcomes, you just get the weight, and then you weight those items or use a statistical method to get for the value. So in our example, we have outcomes 1 until outcomes 4. We multiply them to the weight, and we got 5,150,000 pesos. Okay? And if needed, use the present value. For now, we will not discuss this one because this is advanced. But in case, if you are using present value, what rate will you use now? Pre-tax rate. So in case you will use your present value, the rate to be used is the pre-tax rate. Okay. Once recognized, you measure it. Now, as part of your measurement is your reimbursement. So what is that reimbursement? Normally, provisions happen because of a future amount that you need to settle. And based on the future amount that you need to settle, there can be reimbursements. One example is your insurance. So for example, nakabangga ka, you are a transportation company. Tapos nakabangga yung isa sa mga sasakyan mo. And because of that banggaan, of course, you will be liable. So what is the obligating event? Yung banggaan. Okay? That is the past event which creates now the obligation. And what is the obligation? Of course, to settle any liability based on that banggaan. Now, in case there is a reimbursement out of that banggaan, so normally a transportation company will of course insure himself out of any liability arising on any accident. So based on that accident that can be uh, insured, the insurance can be considered as a reimbursement. So what is the treatment? So for example, it is provided that the damages that you will pay because of the accident is 3 million pesos. However, your insurance covers 2 million pesos. So how will you present that? So damages of 3 million, this is your best estimate, right? You already learned that this is your provision. Now, you have an insurance worth of 2 million pesos. We consider that as your reimbursement. So how will you recognize the reimbursement? So under this standard, it is provided that reimbursements must be recognized separately and you will not net it against the provision. Therefore, the damages will be considered as a liability and the insurance, which is considered as reimbursement, will be separately recognized as an asset. Take note, any reimbursement arising from the provision should be recognized separately and it will not be netted against the provision. So in our example, we have a provision out of damages 3 million and insurance worth 2 million pesos. So the 3 million will be separately recognized as liability and the 2 million will be recognized as an asset. So what is our recognition or when do we recognize then your asset or the reimbursement? You will only recognize recognition of the reimbursement. You will only recognize if ever it is virtually certain. Take note, in the provision, when do we recognize it again? We recognize it only if it is probable. However, for the reimbursement, when do we recognize it? When it is virtually certain. Why? Because again, in your probable, ang sabi lang natin kanina, it is more likely than not. The occurrence is greater than the non-occurrence. Probable, the occurrence is greater than the non-occurrence. However, for reimbursement, it must be virtually certain, meaning it will really happen. A while back in your provision, it can or it cannot happen. However, the happening is greater than the non-happening. However, in your reimbursement, it must happen. So walang non-happening dyan, it will only happen. Kaya nga, it is virtually certain. So why is your reimbursement higher than your the recognition criteria on your reimbursement is higher than your provision? The recognition criteria under your reimbursement is higher than your provision because of the principle of your conservatism. So as you'll have learned before in your AE 100, your principle of conservatism states that it is better to understate your asset than overstate it. And by understating the asset, you will only recognize it when it is really virtually certain. Meaning, if you place it as a notch higher than probability, meaning virtually certain, then sobrang taas ng standard, mahirap siyang emit, mas mahirap kang mag-recognize ng asset. Kaya nga, it is better to understate your asset than overstate it because of your virtual certainty, meaning it will really happen. So once you know that you can recognize a reimbursement, then you measure it. Your measurement must not be greater than the amount of the provision. The measurement must not be greater than the amount of the provision. So in our example, we only have a damages of 3 million. Our reimbursement that we will recognize for 2 million pesos should not be greater than our provision, which is for 3 million pesos. Okay? Reimbursement. Again, you recognize it separately. When to recognize? Only when it is virtually certain. We go now to your subsequent measurement. Your subsequent measurement here is the measurement after recognition. So we have your recognition and then measurement. The measurement we learned a while back is known as your initial measurement. It is the first time that you will measure the provision. And then you will subsequently measure it. It is known as subsequent measurement. So your measurement can either be initial measurement at the time of recognition and subsequent measurement as to the part of your what do we call this one? Balance sheet date or reporting date. So normally during reporting date, we need to subsequently measure items. So subsequent measurement in your provision, this happens during your balance sheet date or your reporting date. So in your subsequent measurement, we look whether it is still probable or not probable. So when we say it is probable, meaning it will still happen. Di ba kanina sabi natin, the occurrence must be greater than the non-occurrence. So, if ever, on your subsequent measurement, you need to determine if ever the occurrence will still be greater than the non-occurrence. Then, if this is correct, it is still probable. If this is wrong, then it is not already probable. So, under your subsequent measurement, you need to determine if ever the provision is still probable or not probable. So when can we say it is probable? If ever the occurrence is greater than the non-occurrence. When can we say it is not probable? If ever the occurrence now is not greater than your non-occurrence. So occurrence now is lesser under your not probable. So if it is probable, any adjustment is presented in profit or loss. Sir, what do we mean by your adjustment? When we talk about your adjustment here, this is your change in your best estimate. For example, on June 15, you have recognized that perhaps your damages on the accident is really 3 million. However, on December 31, circumstances change and you have already estimated that your damages will be 5 million pesos. So there is now an increase on the change, or there is a change on your value of your best estimate. There is an increase. If there is an increase, you recognize that as an additional loss. But if there is a decrease, we recognize that as a gain. So here in our example, from 3 million, it became 5 million. You have additional loss of 2 million pesos. So generally, we have here debit loss. We credit provision for the accident. So we liability, provision liability for accident, we add 2 million. That is 5 million less 3 million. Okay? So if there is an increase because of your new estimate or change in your best estimate, it is treated as a loss. If there is a decrease, it is treated as a gain. Now, what if it is not probable? If it's not probable, meaning the occurrence now is lesser than the non-occurrence, then it must be reversed. So any reversal is presented in profit or loss. So in our example, let's say on June 15, you have recognized that the best estimate on your damages is 3 million. However, come December 31, you have learned that you will not pay any damages at all, meaning it is not already probable that you will become liable out of the accident. So you will not pay any liabilities. Therefore, since you will not pay any liabilities, you need to reverse whatever is recognized in your profit or loss. So in your reversal, you remove the liability, 3 million, and you recognize a gain, 3 million. So in your reversal, you will always recognize a gain. However, in your adjustment, you can recognize a loss or a gain depending whether there is a change on your best estimate. Take note, if there is an increase on your best estimate, we have a loss. A decrease on your best estimate, we have a gain. Again, in your subsequent measurement, what do we look? Whether the liability or the provision, the occurrence is greater than the non-occurrence, or either it is still probable or not probable. We go now to your different types or some items specifically defined or discussed under your past 37. First, we have your future operating losses. So on your future operating losses, we do not recognize it and we will not also measure it. Remember, provision is based on a past event. So there is a past event which creates your obligation. However, in your future operating losses, this is future, meaning there is no past event. Since there is no past event, you cannot have a provision. Take note, there is only a provision if there is a past event which creates your obligation. Here in your future operating losses, since it is future, it is not a past event. Therefore, it cannot be considered as a provision. So not a provision. Therefore, it is not recognized and also not measured. Next, onerous contract. So what is an onerous contract? It is a contract with a consideration in which based on that consideration, you are bound to perform an obligation. So based on your contract, so there is a contract, there is now an obligation. So what is the obligating event there? That is the agreement on the contract. Once you have agreed in the contract, you create an obligation. Take note, one sources of your obligation is a contract. So because of that contract, it creates now an obligation. So the agreement on the contract must be performed by the debtor. So the debtor must, of course, recognize an obligation. So since there is a past event, what is the past event in this case? The contract or the agreement. Hence, it is recognized. Now, how do we measure it? So since this is a contract and the agreement is to be performed in the future, so there is a contract and the agreement, and it will be performed in the future. Your main problem here is how will you measure it? So under the standard, it provides you that you should measure the onerous contract at the least cost of exiting the contract. So what is the least cost? Take note, based on your contract, you will either perform it or you will not perform it. So let's say in your contract, the past event there, you already agreed that you will paint the house of your employer. So that is your contract to paint the house of your employer. If you will perform it, you will uh you will incur, let's say, 300,000 pesos because the house of your employer is very big. And then non-performance, in case you will not perform, you will only pay damages amounting to 80,000 pesos. Okay. So your contract, you will paint the house of your employer. The house of your employer is, let's say, located in a 20-hectare lot. That's why it's very big. So the cost of performance is 300,000. But if you will not perform it, you will pay damages of 80,000 pesos. So under Part 37, how should you measure it? You measure it at the list cost of exiting from the contract. So what is the list cost of exiting from the contract? The list cost of exiting from the contract is the lower amount between the cost of fulfilling it, so the performance, and the compensation or penalty arising from failure to fulfill it. This is your non-performance. So this is your non-performance cost and you're fulfilling it as your performance cost. So whichever is lower, so what is lower? 80,000. So if you will measure your onerous contract, take note, in this contract, we are to particularly perform an agreement based on our what do you call this one, based on our contract, and because of that particular agreement we will either perform or not perform it. So you look into the cost of the performance and the non-performance, whichever is lower, that is the amount of our uh onerous contract or the provision. So list cost of exiting from the contract, take note, future operating losses, we will not recognize it because it is not a past event. Onerous contract, although it will be performed in the future, there is already a past event. What is the past event? That is the agreement in the contract. Once you agree in the contract, it creates an obligation on your part. Therefore, based on that obligation on that part, how will we measure it? Based on your list cost of exiting from the contract. So we're done discussing two specific. The last specific type of provision that was discussed here in your past 37 is your restructuring. So when we say restructuring, there will be a change as to the performance, or there will be a change as to the business operations. So for example, you will restructure your business in Manila, you will transfer it to Cebu, so there will be now a change as to the operations of your business from Manila to Cebu. So if there is a restructuring, when will you recognize it? Take note, out of the three, we have three, right? First is your future operating losses. Second is your onerous contract. Third is your restructuring. Future operating losses is not recognized. Onerous is recognized. Restructuring is recognized. But restructuring is only recognized when there is a formal plan to restructure, and it creates a valid expectation to the users that you will restructure. What is this valid expectation again? The valid expectation is considered as your constructive obligation, and this is considered an obligating event. So if you ask, sir, this restructuring again will be done in the future, but why do we consider it as a provision? It is considered as a provision because of the valid expectation. It creates now a constructive obligation. So your passive event, or your obligating event is that particular valid expectation. So unlike your future operating losses, this is really future based. Onerous and restructuring, although it is to be made or done in the future, there is already a past event or an obligating event. Okay, remember that. In your restructuring and your onerous, there is already an obligating event, while in your future operating losses, there is no obligating event. Okay, so you will recognize it. So you recognize it only if there is a formal plan to restructure and there it creates now a valid expectation to users. Now, how will you measure it? You measure it at the direct cost of restructuring. You measure it at the direct cost of your restructuring. So whatever is the direct cost of restructuring, that is the amount of our provision. Okay, so the three items discussed, we have your future operating losses, onerous contract, and your restructuring. Take note, for your future operating losses, it cannot be recognized as a provision. Onerous, yes. Restructuring, yes. Okay. So again, when do we recognize a provision? If it's probable and measurable. How do we initially measure it? We initially measure it using your best estimate. If there's no best estimate, use your continuous range. If no continuous range, we use your large population of items that is under your initial measurement. Also, you take a look into your possible reimbursement, which should be recognized separately only when it is virtually certain. After initial measurement, we have your subsequent measurement. If your subsequent measurement, you need to take a look if ever it is probable or not probable. If it's probable, any changes on your best estimate is presented in profit or loss. If it's not probable, it is already reversed and considered a gain. Okay. And then we also talk into your three already, your future operating losses, onerous contracts, and your restructuring. Actually, guys, I was expecting that your digest will be like this. Yung parang ganyan lang. Based on your notes. So if ever you try to review based on your notes, you will see these items. Okay, the ideas will come into your mind. It doesn't need to be too wordy. But anyway, it depends on your own notes. So here, take note, after you recognize it, once it becomes probable and measurable, you measure it and you subsequently measure it. So we're done with your provisions. We go now to your contingent liability. A contingent liability is a possible obligation, or it is not probable. However, it cannot be measured. So take note, guys. A while back we said that it is considered a provision if it's probable and measurable. It is considered contingent if it's not probable but measurable, or it is probable but not measurable. Take note, provision if it's probable and measurable, contingent, probable but not measurable, or not probable but measurable. When can we say it is not probable? It is not probable if it is only possible or remote. Kaya nga sabi dito, it is a possible obligation. It is not probable if only possible or remote. So what are the rules then on your provisions and contingent liability? Take note of this. If it is probable, and measurable provision, what is the treatment? You accrue and disclose. If it is probable but not measurable, it is considered contingent liability. You disclose. If it is possible, whether or not measurable, it is considered contingent liability. You disclose. If it's remote, whether or not measurable, it is considered contingent liability, but you ignore. Again, the rules under this standard as to the treatment of your provisions and contingency. If it's probable and measurable, it is considered provision, you accrue and disclose. If it's probable but not measurable, you disclose. Possible, whether or not measurable, disclose. Remote, ignore. Okay? remote, ignore. Next, gain contingencies. What gain contingency that we learned a while back? This talks about your contingent assets. So what gain contingency did we learn a while back? We learned about your reimbursements. And when do we recognize the reimbursement? Only if it is virtually certain and measurable. So virtually certain, measurable, it is considered a gain contingency. So provision on gain contingency, treatment, accrue, and disclose. If it's virtually certain but not measurable, it is only disclosed. Probable, whether or not measurable, disclose. Possible, remote, under your gain contingency, ignore. Okay. If it is a loss contingency, take note, loss contingency, we have already discussed this one a while back. So if that is a loss contingency, that is a liability. If it's a gain contingency, what do we have? An asset. So your provision is more of a liability. Gain contingencies, these are your different assets known as your contingent assets. So please take note of the rules. Let's have an example as to your loss contingency. So losing yan, kaya loss contingency. What are the rules again? If it's probable and it is measurable, accrue and disclose. Probable but not measurable, disclose. Possible, whether or not measurable, disclose. Remote, whether or not measurable, ignore. So those are the rules, right? So let's look at the first one. Dwayne Company legal counsel is convinced that the likelihood of losing the case is probable. So probable. The potential amount of the loss is estimated to 2.3 million. What is this estimated again? That is your best estimate. So is it measurable? Yes. So probable and measurable. What is the treatment? Accrue and disclose. Number two, Dwayne Company's legal counsel estimates the infringement case may result in a loss of 2 million. Loss of 2 million. So this is measurable, but the likelihood is remote. Okay. So if it's remote, whether or not measurable, what is the treatment? Ignore. Next. Dwayne Company's legal counsel estimates that the infringement case may result to a loss of 2.4 million, so measurable, but considers the likelihood as reasonably possible. So it is only possible. So look into our rules again. If it's possible, whether or not measurable, what is the treatment? Disclose. Okay. Possible, whether or not measurable, disclose. Next. Dwayne Company legal counsel is convinced that the likelihood is probable. So it is probable. However, it is currently undeterminable. So probable but not measurable. What is the treatment of probable but not measurable? You will only disclose. Fifth, Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. So probable. The potential amount of the loss based on reliable evidences would be as follows. What do we call this one again? This is your large population of items. So how do we get that? So we get the outcome. So 20% is 1.6 million. 50% is 2 million. And 30% is 2.4 million. So 1.6 million times 20% is equal to 320,000. 50% times 2 million, 1 million. 30% times 2,400,000, we have 720,000. So we will get a total of 2,040,000. Okay. So it is probable and measurable. If it's probable and measurable, accrue and disclose. Number six, Dwayne Company's legal counsel is convinced that the likelihood of losing the case is probable. And the potential amount of the loss based on evidences is 1.5 to 3 million pesos. So it is probable and it is also measurable. So how do we measure it? Based on a continuous range. So what is our continuous range? From 1.5 million to 3 million pesos. We divide it to 2. So 4.5 million divided by 2 is equal to 2,250,000. Okay? So it is again probable and measurable. So accrue and disclose. So in your professions, what is important is to determine whether the item is probable and measurable so that we know it is a provision. If not, it is considered contingency. What is the treatment of our contingency? We either disclose it or ignore it. We either disclose it or ignore it. So that's it for past 37, provisions, contingent liabilities, and contingent assets.